Good morning, good afternoon, everyone. Good evening from wherever you're dialing in from. I'd like to welcome you to this webinar today, and I see there's been a lot of interest. Thank you so much for everyone who's been able to dial in. This webinar is essentially organized between Convergence and Aceli Africa, and purposely to share or to reflect on perspectives gathered from Aceli's work over the past 5 years and reflect on the significant progress that they've made towards mobilizing financing for agri-SMEs in East Africa. And so we will get to hear from John Larea, the CEO of Convergence, on reflections on the importance of Aceli's work in mobilizing private capital. And then we'll get to hear from other participants within the webinar, Brian, and other practitioners within the Agri-SME financing space. So with that brief remark, I'll invite John Larea, the CEO of Convergence, to make her opening remarks. Thank you.
Thank you, Basil, and glad to be here. Just as a brief introduction to Convergence, and maybe perhaps some of you know us, we operate as the global network for blended finance. And since inception, one of the things we've been doing is on a competitive basis, issuing grants to teams who are working on structures that we think could be really important for the field of blended finance. And agriculture is a big deal in blended finance and in the economies of all the emerging nations that we are trying to support. About 20% of all the transactions we've ever seen happen in blended finance have been in the agricultural space. So we received an application from the people thinking about the Aceli Africa concept way back in 2018. I had to look it up, and it was that far back. What we liked about the concept that it came to us with was that generally when we give a grant, we're looking to prove a point, prove out a thesis, not just support a single operator. And what Aceli's originators were asking is it possible, using data, to both fine-tune how blended finance, how concessional money is used in blended finance, and push a field forward, which is the use of, the agricultural lending. We liked the field level significance. We liked the pre-competitive nature of the questions they're asking. We loved the fact that it was not going to be just foreign banks working with each other, but banks from the economies where the action is happening. So that was the setup, and we took a bet on Aceli Africa, and I'm just thrilled to be in the room to hear what happened after we got started. And with that, I will pass it over to the people who will tell the rest of the story.
Thank you, John, for that introduction. And good morning, good afternoon, good evening, everyone. My name is Leonora Onyango, and I lead Aceli's data proposition and the design of our financial incentives. So I'll kick off with a brief overview of what we do at Aceli for those who may not be conversant with our model. So Aceli is a market catalyst that works to unlock capital for small and medium enterprises operating in East and Southern Africa. And to achieve this, we partner with bank and non-bank lending institutions in Kenya, Uganda, Rwanda, Tanzania, and Zambia. So when we think about agriculture, oftentimes we focus on farmers. But there is an important group of businesses that sits between farmers and consumers. And these businesses provide inputs and market access to farmers, and they also generate employment. But the reality is that 3 in 4 of these businesses lack access to finance, despite having a massive potential to drive inclusive agricultural growth within the region. And at Aceli, we've looked at the data around the SMEs that we support. And on average, each business that we support employs 14 full-time workers and creates market access for at least 400 farmers. And so Aceli was essentially set up to address this financing gap for these very high potential businesses. And to better understand why the financing gap exists, we've collected data from over 60,000 loans over the past couple of years to understand the economics of lending in agriculture. And 2 things stood out from that. The first is that it is riskier to lend to borrowers in agriculture than it is to lend to borrowers in other sectors, which means that these borrowers are more likely to default. And the second is that the returns generated by lending institutions on the agriculture portfolio are significantly lower than alternatives they could get, either from lending in other sectors or from investing in alternative instruments such as government bonds. And so Aceli's offering has been designed specifically to address these challenges. And our main offering actually is financial incentives, which are issued to lending institutions. And this is split into two. The first is a portfolio first loss cover, and this addresses the additional risk of lending in agriculture. Lending institutions that partner with Aceli and earn the first loss cover have a pool of funds that they can draw on in the event of losses in the agriculture portfolio. Our second offering is an origination incentive, and this is an upfront unrestricted payment that is made to our lending partners to offset the costs of lending in agriculture. These two offerings are loaded with impact bonuses for women, youth, food security, and climate to further incentivize our partners to target high impact businesses. Beyond incentives, we also offer capacity building to our lending partners to help them build the internal capacity. And we provide capacity building for SMEs to make them investment ready. We complement this with data and learning. And Aceli uses the data we collect to inform our internal offering, but we also use this to share it back to our lending institutions to help them define this, to help them better define their strategies. And we share our learnings back to the market to help develop the full agricultural ecosystem. Lastly, Aceli also plays in the enabling environment. And for this, we partner with policymakers and other ecosystem players to identify and address areas within policies that could be working against agricultural lending. So Aceli was launched in 2020. And in 5 years of operations, we partnered with 55 lending institutions across the region. Jointly, these institutions have mobilized 440 million of capital to over 5,000 businesses. And these businesses have in turn supported 2.3 million farmers and workers. One thing that's really important about these businesses is a lot of the capital mobilized is going to businesses that would otherwise have not accessed this capital, with more than 60% of the borrowers being first-time borrowers. And for borrowers that do come back for repeat loans, they register a 25% growth in their annual revenue. And finally, for every dollar that Aceli pays out to our partner institutions in incentives, $10 is mobilized for on-lending to SMEs operating in agriculture. So with that overview of the Aceli model, I would now like to hand the conversation over to Aceli's founder and CEO, Brian Milder, to walk us through some of the key learnings that we've observed over the past 5 years. Over to you, Brian.
Thanks, Leonora. I'll speak briefly to 4 market shifts, which are highlighted in our recent learning report that you can find on our website. And if I had to distill the last 5 years in just a few words, it would be more and different. So specifically more lending partners and many more loans, but also a different loan profile. More first-time borrowers, as Leonora just alluded, but also smaller ticket sizes, more weighting in local currency loans, food crop value chains to businesses that are selling into domestic and regional markets, and then a smaller share of loans going to export markets. We originally set out in 2020 to work with 20 lenders and to support 1,500 loans. And you can see here that we've ended up engaging a much larger number of lenders, and the volume of loans is well above projected. And that really speaks to the motivation, the pull, and uptake from local financial institutions across East Africa. And I think that's particularly notable given the headwinds that we've seen in the last 5 markets. We launched during COVID. Of course, there's been ongoing and increasing climate stress, and also geopolitical conflict in Ukraine, Iran, which has led to spikes in fertilizer prices. So there are many drivers for the growth in lending, including internal factors like pressure from senior leadership and boards of financial institutions, as well as from governments that are looking to be more food independent in the wake of COVID, seeing the rising price of food imports. But one of the key drivers has certainly been the financial incentives offered by Aceli, which shift the risk return for lenders. And when Aceli entered the market, the status quo looked something like this. Because of the elevated real and perceived risks and transaction costs, loan profitability in agri-SME lending was low. And that in turn led to lenders under-investing in the sector, allocating small amount of capital, but also not dedicating staff to agriculture and serving agriculture and agri-SMEs as they would any other SME. And often that translated into loan products that weren't tailored to seasonal cash flow cycles, as we know is critical in agriculture. Loan officers not knowing how to manage and mitigate risk in agriculture, and then consequently loans that didn't perform very well. And so the cycle continued and reinforced itself. And the incentives played an important role in shifting that cycle, defraying risk, improving profitability, and then motivating lenders to reinvest in agriculture, allocate more capital, but also develop sector-specific strategies, adapt their product offering, really go deeper and understand specific value chains, and then hire and train more specialized staff who are prepared to find and serve agri-SMEs. So that positive reinforcing cycle isn't notable just because more capital is going into agri, but where it's going. It's reaching underserved businesses and particularly those with a high impact profile. And you can see here that there's been a significant increase in the loans to women-owned businesses on the next slide. So the dark line shows the share of loans to women-owned businesses going from just 9% in 2022 to 29% this year. And that hasn't been accidental. It's been a product of a number of things, including adjustments to Aceli's incentives. So in 2023, we lowered the loan size minimum from 25,000 USD first to 15,000 and later to 10,000. And we did that specifically for businesses owned by women and youth in recognition that those entrepreneurs often lack formal title or assets, fixed assets to qualify for larger ticket size loans. And we've seen in response that lenders have proactively shifted their strategies, targeting women and youth-owned businesses. And you see that growth here in terms of both the percentage of overall loans, but also the volume increase in lending to women and youth-owned businesses. And those increases have also been complemented by advisory. So a partnership we have with Value for Women to offer gender lens advisory to financial institutions so they can adapt their strategies and product offering. So I think the key takeaway here is that financial incentives calibrated to risk return barriers can play a powerful role in aligning the business case objectives for financial institutions with the impact objectives of mission-driven actors. And I'm going to now go to the last market shift. So incentives plus lender commitment set this activation cycle in motion. And you can see that on the right. But then other drivers really accelerate and amplify it. So capacity building for financial institutions, as I've just talked about, but also then technical assistance on the demand side, preparing more SMEs to access and manage financing. So when we launched in 2020, we had a TA component for SMEs, and our hope was that lenders would refer businesses into that program and then finance them on the back end. lenders weren't interested. It was COVID. They hadn't yet benefited from the incentives, and they didn't really engage in the TA program at all. And now fast forward 5 years, lenders are coming to Aceli saying, we've identified a pipeline of potential borrowers. We want to prepare them to qualify for financing. Can you work with us to offer pre-investment technical assistance? And so we see this really interesting interplay between the incentives and capacity building on the right-hand side, activating the capital supply, and then lenders having more of a pull and interest and building the addressable demand and serving that demand. And we publish some of the learning and findings around technical assistance in a recent learning brief, which you can also find on our website. So with that, I'll stop, hand it back to Leonora to introduce our panelists.
Thank you, Brian. So you heard from Brian around the market shifts that Aceli has observed, but now I want to bring this to life and really speak to the people who are behind this change. So for today's conversation, I'm joined by two practitioners who are at the forefront of driving agriculture within their institutions. The first is Hannington Namara, who is the Managing Director of Equity Bank in Rwanda. And the second is Ezekiel Vose, who is the Head of Client Solutions at I&M Bank in Kenya. Thank you both for making time for today's conversation.
Thank you, Leonora. Happy to be here.
Thank you very much. Thanks for inviting us.
Thank you. So why don't we just get into it? Let's start with equity. Hannington, equity has had an extremely transformative journey in terms of agriculture lending. So could you paint a picture for us of what did agriculture look like within your institution 5 years ago in terms of your portfolio and your lending strategy and how that has evolved over time?
Right. Thank you, Leonora. Thank you, Aceli and Convergence for organizing this. Good afternoon, good morning, or good evening, wherever, depending on where you are. As introduced, I lead a team at Equity Bank Rwanda. Talking about agriculture is a big and oldest story, if I may say. But allow me paint a picture of before and after. About 5 years ago, we were confronted with COVID and its effects. And the group or the board of the Equity Bank Rwanda decided to refocus the bank and said, for a long time, we've been attempting to do agriculture. We didn't know how to. And the bank decided, no, we must now look at God-given sectors to keep our customers' lights on. And agriculture, since every one of us eats or drinks something from the gardens, we decided we must make sure agriculture becomes a profitable venture. So back in the day, agriculture represented a very small percentage of the book, and it was to do with the formal agriculture, particularly the export-oriented actors, but wasn't really so much on production level. We decided to then say, let's cautiously but intentionally start looking at ways we can go into agriculture. To give you an example, agriculture back in the day, I think I had a small book about $5 million. And now, proud to say that we have an exposure of over $20 million in the space. Baby steps, like I said, we began 5 years ago, but we wouldn't have gone to that level had we not looked at agriculture as an area that is potential, that has potential for transformation. And we started looking at how do we do this. We, of course, combined the use of data, evidence-based risk management practices, but also began to understand or to discover that we can't do agriculture alone, that we needed support of partners. And allow me at this point to thank Aceli for coming on board and hand-holding us to ensure that we do agriculture in a more thought manner. It is important to note that agriculture back in the day was treated as a specialized segment that had too many risks that we would all look at from our credit policies and say there are also types of risks, weather risks, market volatility, high transaction costs, and obviously limited financial records that we could look at across the entire value chain, from production to the SMEs to the agro dealers to except the marketplace where you had a bit of data. So we started looking at, how do we undertake a learning? And as I think it was Brian who said, we started off by saying, let's have a transformation from within, have a holistic approach, have a strategy, number one, that allows us to decide which value chains do we begin with. Number two, let's build capacity internally for the staff. So from, I think at the time we had almost a staff or two at the head office that were doing, the export type of agriculture, and decided how do we roll this down into our branches. We now have 36 branches, and proud to say in each of those branches we have an agri specialist in the branches to deal with agricultural lending. And when I say agricultural lending, you begin from the farmer to the SME in between and to the market actors. So that started shaping. And then we also said we will not do agriculture internally, even if we have built capacity internally, without capacitating the actors. The program Brian mentioned of capacitating farmers and the actors was very instrumental. In fact, for equity, it came at a time because we were also setting up the foundation in Rwanda to do what we call brand softening. So we started doing a lot of capacitation programs with the actors, from the farmers themselves in production, at production level, to the SMEs that are involved in the trade of different inputs or crops after harvest, or whichever products, not just crops. And then, of course, the market actors. That showed us a lot that agriculture can actually be a significant commercial opportunity, capable of delivering jobs, capable of delivering impact and sustainable returns. The turning point for us, in fact, was when we began building these coalitions, establishing partnerships like Aceli, and it's when we started realizing that this approach would actually get us to learn how to put our arms around the risk, as we call it in the banking sector, in agriculture lending. For us, the change has not just been the numbers on the balance sheet. It is actually the institutional confidence we've built over time, and transforming that confidence into actionable products and services, and beginning to see the projects, the farmers, the actors who are financed becoming profitable and capable of scaling. To us, that has been a very big achievement. If I was to paint 5 years ago where we were and where we are today, we actually got inspired and started looking at agriculture to become a significant player on the bank's books. Today, the board has given us a KPI of achieving by 2030 to have 30% of our loans, total loans, in the agriculture sector. We wouldn't have been able to even dare accept that KPI if we didn't undertake partnerships of the likes of Aceli to help us understand and build confidence, because we would look at agriculture. As I said earlier on, we had looked at agriculture and we were not sure whether we will not be looked at as reckless lenders until we met the likes of Aceli and held us by the hands. And I'm proud to say that we could confidently put it out that we can become an agriculture bank.
Thank you for that response, and when you paint quite the picture about what the journey really takes, changing the mindsets, building capacity, being deliberate about what you're doing. And, just for the audience to get this context, when we say we're targeting 30% of your agriculture, of your portfolio being in agriculture, across the region, most banks don't even hit 5%. So 30% is, a quite impressive target, and Aceli is very happy to be supporting you on that journey. So let's turn it over to Ezekiel now. Ezekiel, I know I&M has gone through a similar journey of transformation. Previously, I&M has mainly been known as a corporate bank, not focusing so much on SME and agriculture. So could you walk us through the journey of how agriculture became a focal point for the bank and what it took to get there?
Yeah, thank you, Lonara. Thank you, Huntington, for sharing that impressive story for Equity Bank Rwanda. I think it's a similar story for I&M Bank, although slight differences. So if you can recall, I&M Bank was majorly a corporate bank in the previous years. So majorly a corporate bank and a niche bank within the premium banking sector. The bank adopted a strategy called Imara, and that Imara strategy basically was focusing the bank towards new revenue lines. Now, what that meant is that the bank needed to look into what other growth areas there exist in the markets that we operate in. Remember, I&M Bank is a regional bank. And then to ask ourselves which sectors do really possess opportunity. And agriculture was one of the sectors that was identified for growth. Now, the bigger question was, this was about 3.5, 4 years ago, how do we go into this particular space, given the perceived risks, the real risks, given the performance of the banks that have gone ahead of us, the financial institutions that have gone ahead of us. We took time to study them and look at which operating models they were employing. And at the point when we were trying to make a decision to go, of course, we needed partners who would help us to ensure that we manage the risk properly. And we went into the market looking for partners, and we looked at some partners, but we were not satisfied with them. But then we bumped into Aceli. And when we looked at the risk guaranteeing structure that Aceli, provides to institutions, we were really impressed. We were really impressed, and then said, this is now the partner that we'll go with. Now, at that point in time, it's not that the bank wasn't doing agriculture, but really the bank was underwriting agriculture reactively, and especially for big corporates. It was never going to go, into the SMEs, into the individuals, into the medium-sized enterprises. So for us, at that time, it was a big no. It was only for big corporates. And the big corporates, why? Because for big corporates, you've got a lot of tons of information that you look at. You've got past historical performance that you can verify, and the strength of the company actually is a deal when you're assessing those kind of things. Now, I think with Aceli, when we bumped to the Aceli guarantee, we presented it to our management team, and all of them were impressed. And then that gave us the catalyst, the impetus now to get into agri-lending. Now, from that time to now, we have done quite well. Just to give you perspectives, we've had some very impressive numbers. At that point, we were sitting on about 1,000, agri actors within our books. Right now, we are heading into 50,000, which is superb performance over 3 or 4 years. We've had impressive numbers over time, over the 3-4 years that we have been, attending to agriculture. The number of women borrowers, for example, has moved from 17% in 2024 to about 37% in 2025. And also, if you look at other data points, you can clearly see the number of youth borrowers has moved from about 24% to about 32% over the same period. This is actually testament that when we are aligning our agri-finance strategy, we are also aligning it to impact areas that Aceli has focused on, and these are areas also which are in line with our Imara strategy, and also in line with the our recently approved sustainability financing framework, which is a board policy that now governs how we interact both on the green financing and also on the agri financing. So I think for us, it is a wonderful story over a short period of time. We're currently sitting on a book of about $80 million, and we are happy that quite a significant amount of that book sits within the Aceli guarantee. And important to mention that even though we are working with Aceli, the confidence that the bank has gained over time and the learnings that the bank has gained out of the loans that we are underwriting, we are seeing a spillover effect that we are able also to take risk in areas that are not focused by Aceli, but because we have learned and we've gotten the confidence, we are able now to, get that business, or rather support those requests that are coming from those areas that are not essentially covered within the Aceli guarantee. So for us, Leonara, it has been an exciting journey, a wonderful journey. It's a story that we always look back on, and we are always excited. And we think, as our friends in Equity Bank Rwanda are saying, I think we can actually be the agriculture bank in Kenya.
That's great to hear, Ezekiel. So in a couple of years, I am agriculture bank in Kenya. Yeah.
Yes.
And and the 50-fold growth that you've talked about, in just 3 years is quite impressive. So Ezekiel, if I could just stay on you've talked quite a bit around the risk guarantee and how that has been instrumental in shifting mindsets within your institution. But beyond the risk guarantee, Aceli also offers origination incentives. And one of the defining features of this is that it is an unrestricted payment, which means we allow lenders to decide how they want to use those incentives. So could you walk us through how I&M has used the origination incentives paid to you by Aceli, and what that has meant in terms of the growth story for your agriculture portfolio?
Yeah, so as I mentioned to you, yes, we have had a very successful story within the agri space. Now, obviously, let me speak to the first loss cover first of all. The first loss cover, incentive that we get from Aceli has been very instrumental in, giving our colleagues in credit the courage to approve the deals that we present. Currently, we are sitting on a very significant pool of funds. And just happy to note that because of because of our rigorous, robust credit underwriting framework, even for these agri-SMEs, I think our non-performing loans have been quite, significantly lower when you look at compared to the industry average, which is about 16%. As of last year, our non-performing book was about in the ranges of 4%, which is a very attractive position. Nevertheless, that first loss cover continues to be a very strong motivator on how we structure deals. And to that extent, also drawing from the origination incentives, we have been able to, invest in improvement of tech that they're using to target these smallholder farmers. These agri-SMEs, we want to have sort of a digital offering that we are able to use to service them and therefore scale. Apart from that, part of that origination incentive is also being used to, resource and, increase our resourcing capacity, especially around servicing the impact areas that Aceli is focused to. And those impact areas are also the impact areas that are captured within our sustainable finance framework that has been approved by our board. So in a nutshell, I think it is a very good story. It's a very good use of the incentives, origination incentives focused on investment, both on tech, both in human resources that are focused in driving agri, and the first loss cover just essentially giving us the courage for us to be able to underwrite even much more, business. And also the spillover effect that now, because we have learned from this, that we have underwritten under Aceli, we can now stretch even further for us to be able to support, further actors within the value chains.
Yeah, thanks for that response, Ezekiel. And I think that ties into Brian's presentation around how incentives go beyond just driving more lending, but actually shifting mindsets and shifting the way institutions think about the lending, the agricultural lending portfolios. So Huntington, if I could pose the same question to you on the equity side, how have you used the incentives that Aceli has paid you, and what has this meant in terms of your ability to grow your portfolio?
Thanks, Janelle. And I just want to probably re-echo what my colleague says on the Aceli model, let me call it that way, of combining both the first loss cover and the incentive cover incentives for origination. I think the two were carefully thought to the extent that, the first loss cover allowed us to venture into areas we would not have been. Cooperatives, smallholder farmers, those without financial information that have no form of collateral, we wouldn't have touched in the circumstances because, they would be looked at as very high risk or risky, that enable the lending to those who will be deemed to be impairing capital of the shareholders. So that to us, I think, as my colleague says from I&M Bank, was a very good thing because it allowed us to go to those smallholder businesses. And we've learned a lot, I must say. We've learned a lot, the types of cooperatives that we now have as customers. There are members who have enrolled and borrowed directly or through our digital channels. The women being majority of those, the young ones who had originally looked at agriculture as a non-starter because of the requirements by financial institutions, but also because of the risks there. The youth now being in agriculture, without talking about the data which we can avail, but I think the learnings are what is important, the mindset of the lending institutions to go there. And I said the two go hand in hand. The incentives for origination really played a big role. It be the internal teams in Equity Bank here. As I said, we have agri experts in all our branches. They now go look for agri loans, which they would pass by farmers or agro dealers and not look at them because they would think there's no business from them. Now they go looking after them. So the incentives motivated our staff in the credit origination side to be able to do better. But they also helped us to do a couple of things. We channeled majority of or a big portion of the incentives into capacitation or capacity building programs. That helped us, develop competencies by providing technical assistance to borrowers and strengthening their capacity, particularly focusing on cooperatives, VSLs, the village savings groups, and small enterprises that are in the agricultural space. And that allowed us to strengthen governance, to strengthen financial management, bookkeeping, market linkages, all those things that would not have happened had we not had the incentives fund to actually develop that competence. As you know very well, it would have been difficult for me to go to the board and say, allow me a couple of hundreds of $1,000s to go spend on capacitation without an end in mind. On this, because the incentives fund was flexible, I was allowed to take, let me call it a risk, to use it in areas I didn't expect to get. I couldn't paint or put a picture as to whether if I spent $1, I'll make $2. But I actually ended up making $3. But in the conventional ways, I wouldn't have been allowed to spend that money on capacitation. And I'm proud to say that had it not been for an incentives program, I would not have done. Maybe I would have done, but much later or with difficulty. But the resources that were made available to us through the incentives package have actually have helped me leapfrog what I wouldn't have done in the market. So really, for me, I would say incentives have helped us undertake a journey that would have been seemed to be difficult, but also helped us build technical competencies and stronger relationships with our customers. They now understand when we say we want to be an agricultural bank, in fact, not just customers, broadly, even within the government of Rwanda, the environment here, when you speak of, when I go attend meetings of agriculture sector or food sector, the example to use is equity. How come equity has done this? And they don't know at the back of all that there was Aceli powering me to do all these things. So I would say thank you for the two incentives and the loss cover packages that have gotten us there.
Yeah, thanks for that response, Hannington and Ezekiel, and really just painting a picture of the catalytic impact of the incentives and how they give lenders the courage to basically seek out borrowers that they would not have sought out in the past. Yeah. So we've told a great story around the growth that we are seeing in the agriculture portfolios. But a question that comes up a lot is the question of sustainability. And maybe we can continue with you, Hannington. Equity has registered this great growth. We know you have plans to continue down this path, but could you walk us through how, as an institution, you're thinking about sustaining and deepening the growth you've registered in your agriculture portfolio, and particularly, as you move beyond the initial push that was generated by the incentives?
Okay, maybe perhaps that's the elephant in the room question. I would say our goal is to not just to grow agricultural lending as a bank, while incentives exist, but also to embed agriculture in the financing products and services of the bank as a permanent and profitable business line. That's our goal, and that speaks to the sustainability of it. Because unless we are able to do that, then it will be difficult to get boards and stakeholders approve of our intervention, our intermediating model. And we can only do that if we manage to do certain things. And I think I would say that we have actually started doing. We've made sure that our lending policies have been mainstreamed to include agri-lending as a sector that we must focus on. Remember, I said now we've been inspired to target 30% of the book. I don't know in number terms, in 2030, my loan book is likely to be 1.3 trillion Rwanda francs. 30% of that is about 600 or so billion Rwanda francs. If that amount of money will be in the agriculture sector, how many jobs can we produce? So start with making sure that agriculture processes, lending policies have been mainstreamed. Our strategies are in place so that to back the policies. We've also made sure that we have capacity in-house to understand agriculture risk across the value chains. We've also made sure that we embed dealing with the risks, and on top of the risks is climate related risks, making sure, my colleague talked about sustainability plans. Our sustainability strategy on agri seriously focuses on climate risk interventions. We've also made sure that as we do all this, technology plays a bigger role. There's no way I'll open a branch at every village. We rely heavily, and agriculture is in the rural areas. What we've made plans to do is digitize heavily and introduce the digital financial services solutions that will be relevant to the farmers on a day-to-day basis, based on their crop cycle, based on their cash flow cycle. So, and we will only do that, be able to lend if we use data analytics. So we're able to learn better about the value chains they are in, the challenges that they are involved but are in their area. So we're able then to do this sustainably. So I would say, even if there are certain incentives were to dry out, allow me to say, or the guarantee was not to come back, what we have so far achieved, even though it's baby steps, can give us hope and confidence that it will be sustainable. Obviously, I would not say that we've done enough. There's room to do more. If the incentives and the first loss cover program is extended, I will be the happiest, because then I can achieve what I didn't achieve 5 years ago because I was a baby learning how to walk. Now that I am a full grown adult and I can run faster with a bit more support, I can run faster and get to the destination faster than anticipated. Of course, the ultimate success for us is to see things continue, to continually seeing agriculture become a commercially viable and sustainable venture. And we believe we are well on the right path to do it, to getting there. So I would say, the Aceli program has helped us form the foundation for the last 5 years, has helped us do what I would call proof of concept. We've tested it, it works. The rest is to scale. Given the opportunity, I would welcome the support again.
Yeah, and it's great to hear about the bank being intentional around, sustainability and embedding agriculture in your processes, and really working towards, the commercial viability, and really speaks to what Brian, presented around the negative to positive cycle. So Ezekiel, would really love to hear I&M's perspective as well on this. How is the bank thinking about the sustainability of your agriculture lending portfolio?
Thank you, Leonora, for the question. And also thank you, Huntington, for bringing out some of the same perspectives that we hold as a bank around sustainable agriculture. Now, I think for me first is that if you recall, I mentioned that apart from, investing in agri players that Aceli focuses on, we've also started seeing spillover into other, value chains that Aceli is not focused on, and also, agri actors. So for me, the spillover is already a testament that the bank is already implementing sustainability in terms of whether the Aceli guarantee or any other guarantee will be in place in the future or not. So for us, we're already thinking about sustainability, and we're already running scenarios by the spillover that I had mentioned. Number two is around our utilization of the origination incentive, which we are actually using that money to invest in the relevant technology platforms that will help us to connect to these smallholder farmers, that will help us to connect to these ecosystems, and therefore be able to give us eyes in the things that we want to see. So how do they operate? How is the cash flowing amongst themselves? Things that credit risk underwriter will be asking themselves when they're looking at a case. The same tech is supposed to, basically help us to move away from the collateral-based lending, old way of underwriting, agri-finance deals, to cash flow and ecosystems based structures, which are anchored around, strong off-takers. So that investment, using that origination incentive to invest in that particular tech platform, for us already is a testament of sustainability. The third action that we are taking around sustainability is around using some of that origination incentive also to invest in the right skill set, to invest in agri-specialists. Obviously, agriculture is vast, so many value chains that you're dealing with. Today, you're seeing an application around potato. Tomorrow, you're talking about macadamia. The next day, you're talking about, mushrooms. So the value chains are so many. It's not like conventional lending where the underwriter will always just be thinking about a salary loan. So you will see salary loan January to December. But in agriculture, the applications are very different. The use cases are vast. So for us, getting that skill set embedded into the banking into the bank, especially in the credit department and in the business development department, that particular skill set is already being sourced, and it will really help in the sustainable into the future of how we conduct agriculture. And also, piggybacking on your technical awareness programs, I think we've had quite a number of them. We are having another one, I think, is it next week, which then focuses on how do we embed agri-finance knowledge in business teams, in credit underwriters, in processing teams. Once we soak everybody in that knowledge, I think handling of those deals and handlings of those applications will become much more easier. So for us, we're doing that. And also there is another challenge that is, I think Aceli is helping us with the Central Bank of Kenya around how do we do a taxonomy that then supports reporting, supports effective credit risk portfolio management, so that we are able to deploy remedial actions, so to speak. If we see a particular sector, particular behavior in a particular portfolio, we are able to deploy proper remedial action. We are able to classify loans properly, so that we are able to see what kind of investments we are doing within the agri sector as we finance them. I think last to say, the way my colleague has said, I think in the strategy of the bank, our North Star is about to get to about 20% of the bank's portfolio in the next medium term. And for us, that means significant revenue contribution to the overall bank. By the time we get into 10 years, I think we should be speaking about a 50-50 contribution to the total asset portfolio that the bank holds. So for me, agriculture is a very interesting journey for us. We have seen some very interesting, cases, so to speak, and we're excited to be part and parcel of this journey. And thank you, Aceli, for coming on board and, jacking us for us to get into this space. So thank you, Leonara, and back to you.
Thank you, Ezekiel. It's great to hear what the bank's vision is and the very concrete investments that you're making to get there. So now I'd like to thank you both, Ezekiel and Hannington, for taking time to paint a picture of what it actually means to lend in this space, the journeys you've been on, and the vision that you have moving forward. So we'd like to look at it more broadly and really jump into the blended finance sector in general. And so, John, I'd like to pose a question to you now, being part of Convergence and having this bird's eye view of everything that happens in the sector. So Ezekiel and Hannington have talked about the catalytic effects, of the incentives and the role of catalytic capital. And we also know all through the world, in high-income economies, agriculture is subsidized in some form. So it will bring it home to the African context. Where do you see the role of blended finance, in the long term, and especially in light of the changing development finance landscape?
Thank you. Yeah, I was listening with so much interest. Thank you both for your real experience. As we all know, there's not an awful lot of concessional capital out there, catalytic capital of the type that Aceli uses in this program. So the question in front of us is how to use the tiny bits that are left to do something really powerful. And what I hope the audience is hearing is that Aceli is not a subsidizing device, but a learning device. The point of the experiment is for all of these commercial institutions to be figuring out where they need help and how much help they really need. One thing that blended finance suffers from generally is people putting catalytic money into a structure or a proposition without having any data as to how much of it was needed and where was it needed. So if you listen to what Ezekiel and Hannington are saying, they've been asking the questions and answering the questions of where those subsidies are needed. Is it to get a bank like I&M or Equity Bank to originate loans and to be comfortable doing so? Is it to shore up the economics of a specific part of their portfolio? Is it to get their people to support underserved segments like youth and women we were hearing about? So what I like about this version of blended finance is that the model through this learning device kind of slims the area in which blending is used, right? In the present sense, we now know more, and we can aim that tiny bit of concessional capital out there into the pieces and parts of the equation where it's actually used. I think I just heard Ezekiel say that only half of their portfolio is actually using Aceli support. So the second field level question is, so if we have slimmed the amount of concessional capital and targeted it and surgically applied it in the present tense, what does that look like over time? And you're absolutely right. Agriculture is subsidized in wealthy countries as well. So before anybody on the phone sitting in Paris or Toronto says the off-ramp should be absolute and near term, I would challenge you to look at your own economies. But the question is, what is that off-ramp, right? And, how can we make a steeper glide path longitudinally over time away from the kind of support that Aceli has provided and using the learning that Aceli has provided? And I actually don't think it's for someone like me to have the answer. I believe that as overseas development aid, as foreign aid diminishes in places like Rwanda or Kenya, the continent of Africa writ large, the folks on the ground, the stakeholders in, say, Rwanda or Kenya or other places are going to have to figure this out on their own, and they're going to be in the driver's seat. So I don't know what the end game looks like, but I don't think it's for me to know. I think, the baton gets handed over and the control and the thinking lies with the people on the ground. It is the policymakers of Africa. It is the banks and the institutional actors of Africa. It's the voters who are going to figure out what level of subsidy or what term and what places should exist. But what I love, again, about this device is we know more. We know so much more about where we have to be with any soft money that does come in. It's not a black box. You've all shared data back and learned from that data, and that's a really powerful thing.
Yeah, thank you for that response, John. And I love how you've closed it out. We know more, and that is really guiding how we're going to move forward. And so with that, I want to hand it back to Brian to really tell us what the future looks like for Aceli. So Brian, where do you see Aceli heading over the next 5 years?
Thank you, Leonora. Thank you, Hannington, Ezekiel, Joan. And I mean, for me to hear Ezekiel and Hannington use words like motivation and confidence, but then to connect it to concrete changes in practices, going from collateral-backed lending to cash flow-backed lending, investing in capacity building, and then seeing the returns, and then the spillover effects. It really points to what we've been trying to accomplish, and then where I think this is heading. So briefly, scale, we want to 4x, quadruple the volume of activity. You can see some of the metrics on the right. Of course, financial sustainability of our model. About a month ago, we adjusted the origination incentives. We'll be able to stretch every dollar about 15 to 20% farther this year. And we expect that the 10x leverage Leonora mentioned earlier will be 15x over the next 5 years. And then the third, and this speaks to what Joan was just getting at, is how do we take a model that's been demonstrated with private sector lenders and begin to coordinate and embed much more intentionally into the country level policy environment? And that deserves its own full hour at least. So I won't try to summarize that in 60 seconds, but we've been partnering with bankers associations, with other ecosystem actors, their policy working groups in each country, addressing technical regulatory issues with central banks, and starting to pave the way and make the transition for this model to be embedded into the country level environment. So thank you to our partners at Convergence, our lending partners, I&M Bank, Equity Bank, the 50 plus lenders who weren't able to participate in the conversation, but have are driving this growth forward in the agri-SME finance sector. And I think we can close it there.
Yes, thank you, Brian, and thank you everyone who made time to join the call today. We've tried to answer as many of your questions on the chat, and we hope that you learned a lot from today's session.